It's time for our July update of our $124,000 Tfsa dividend growth portfolio. In this video, we share our 20 holdings and which stocks we bought in summertime. Let's do this. For the newbies to the channel, my wife and I do our finances together. So we have 3 accounts through 2 brokerages for our Tfsa, Scotia iTrade and Wealthsimple. The month of July was interesting, to say the least. Earnings season was in full swing and will continue into August. Our portfolio was down slightly on the month, and it continues to underperform the NASDAQ, S&P 500, and Dow Jones. After beating all 3 of them by a wide margin last year, it is losing out on the upside this year. With a long-term outlook, I don't let the month-to-month or year-to-year performance shake me. Before we begin the update, I have some very cool news to share. We're excited to tell you about the soft launch of moomoo Canada. Think Yahoo Finance meets brokerage, but on steroids. There's a desktop and mobile version of the app. One feature I especially love is the very comprehensive stock screener, as you can see here. And it is great for paper trading for those new to investing. If you're like me and like free, sign up to moomoo with my link below and have the chance at winning some amazing giveaways like a $100 Amazon gift card. Now let's get into the updates, starting with VFV, Vanguard's non-hedged S&P 500 index ETF. It makes up 0.2% of our portfolio. It was up 3.4% on the month. Our allocation target of 5% remains our goal. The index is trading at a PE of 26.56, up from 25.76 last month. Historically, with a PE above 25, returns have been muted or even negative. Next, we have goeasy Financial. It makes up 0.4% of our portfolio. It finished the month up 13% and is now up 44% from its low in May. That's pretty ridiculous if you ask me. goeasy is in the credit services industry. It provides non-prime leasing and lending services to consumers in Canada that wouldn't normally qualify at a traditional bank. It has been growing its dividend at a 5-year CAGR of 38% and a stock price 5-year CAGR of 24.3%. goeasy reports Q2 earnings next month. Next, we have Canadian National Railway. It makes up 0.9% of our portfolio. It finished the month down 1% and is down 2.5% year to date. Q2 earnings were released, and it was a little telling to the current state of the economy. Revenue, down 7%. Earnings per share, down 9% year over year. And they updated the 2023 financial outlook. EPS growth of mid-single digit is now flat or slightly negative earnings per share growth. CNR is expecting recovery to be pushed to 2024. Short-term pain is fine and dandy for me. Next up is Brookfield Corporation. It represents 1.7% of our portfolio. It finished the month up 4.5% and is now up 6% year to date. Brookfield Corporation is an alternative asset manager and real estate investment manager that focuses on, you guessed it, real estate and renewable power, infrastructure, and venture capital and private equity assets. Because of the real estate turmoil, especially in the States, Brookfield Corporation has been suffering. BN reports Q2 earnings next month. I'm looking to continue to build this position to 250 shares. Next, CANOE EIT Income Fund makes up 2.4% of our portfolio. It is up 3.5% on the month and is now down only 2.7% on the year, not including its distribution. Its 5-year performance is looking better and better at 14.3%, beating the S&P 500 by a wide margin. Next up is FIERA Capital. It represents 2.8% of our portfolio. FIERA finished the month up 1% and is still down 25% on the year, not including its dividend, of course. We maintain this position on the chopping block with its fundamentals worsening and our investing thesis no longer really holding. FIERA reports Q2 next month. Let's hope we see some stabilization of its AUM. Next, we have TD Bank at 3.6% of our portfolio. It finished the month up 6% and is now only down 0.8% on the year. This is no longer the worst performing bank in Canada. With the Canadian economy slowing and inflation sticking, the Bank of Canada raised interest rates another 25 basis points. And the situation in the US is indicating higher rates are here to stay for longer, and that has been tough for equities. The financial, telecom, utility, and real estate sectors have been particularly hit hard. We're looking to build this out to about 155 shares in the near term. Next, we have the YouTube like and subscribe button at 100% of our channel. It costs you absolutely nothing, and we are so grateful for you guys tuning into the channel each week. Next up, ALGONQUIN Power and Utilities Corp makes up 4% of our portfolio. ALGONQUIN was flat on the month and is now up only 18% on the year. At one point, it was up 30% on the year, not including its dividend. Some big news that I mentioned last month was that Starboard took on a 5% stake in the company. They said they purchased the company's shares on the belief that they were undervalued and represented an attractive investment opportunity. I still think the next few quarters will be telling on how the stock performs and which direction the company's fundamentals go. They report Q2 next month. Get ready for it. We dripped 2 shares at $10.74. That added $1.16 to our annual dividend income at a yield of 5.4%. I must note the drip discount no longer applies, and this was an oversight for not turning off the drip. Next, we have MANULIFE Financial Corporation. It makes up 4.5% of our portfolio. It finished the month up over 5%, which has brought its 5-year CAGR on its stock price to the low 1.8% range. Manulife continues to print cash essentially, giving it the ability to raise its dividend 10% annually over the last 5 years. We have about 2/3 of our position built. I'm looking forward to the next few quarterly reports for signs of weakness so we can accumulate more shares. MFC reports Q2 next month as well. Next up, we have BCE Inc. at 5.2% of our portfolio. Telecoms continue the slide, and BCE is no exception. It's down 6% on the month and is down 13% since its May high. Q2 results are out at the beginning of the month. I'm really curious to see how they are handling the higher interest rate environment. We dripped 1 share in the middle of the month at $58.82. That added $3.87 to our annual dividend income at a yield of 6.6%. Next is Fortis. It represents 5.9% of our portfolio. Utilities are also getting hammered in this high interest rate environment. It finished the month down 1.5% and is now up only 1.6% on the year. Nothing too much happening here. We shall wait until next month when they also release Q2 earnings. Next, we have PEMBINA Pipeline Corp. It represents 5.9% of our portfolio too. It traded flat on the month and is still down 7.5% year to date, not including its dividends. PEMBINA will be reporting Q2 next month. The last quarter, we saw emphasis on improving the balance sheet, as they are still carrying about $10 billion of debt. This still has a very healthy dividend payout ratio, so I can still see them raising the dividend 3 to 5% while paying off debt to reward shareholders. Next up, we have TELUS Corporation at 5.9% of our portfolio. TELUS remains stuck in this downwards channel since April of 2022, and it's looking quite oversold, yet the selling just does not stop. It is down 9% on the month and nearly 11% on the year. There has been a lot of coverage on YouTube and other social media platforms about the sustainability and profitability of TELUS. I'll just say it as it is in my perspective. I have no clue about how telecoms work. Excluding the effects of their accelerated capital expenditures program of $623 million for the most recent 4 quarters, as of March 31st, 2023, the payout ratio was only 62%, well within their guidance of 60 to 75% of free cash flow. So we continued the buying spree and bought 31.7 shares at an average cost of $24.39. This added $46.13 to our forward annual dividend income at a yield of 6%. We still have a lot of buying to do. Our next biggest position, ENBRIDGE, represents 6.7% of our portfolio. It finished the month down 1.5% and is now down 9% year to date, not including the dividends as always. Just like with PEMBINA and other energy stocks, ENBRIDGE is super high yielding right now. It is important to note its payout ratio is still healthy. We will get a better idea of how things are going at the beginning of August when Q2 is released. We bought 2.2 shares at an average cost of $49.35. That added $7.96 to our forward annual dividend income at a yield of 7.2%. Next is SmartCentres Real Estate Investment Trust at 6.9% of our portfolio. It gained 3.7% this month and is still down year-to-date 8.7%. Real estate has been suffering, as anyone living in Canada or the US would know. Thankfully, 26% of rental revenue is coming from a stable company, Walmart, and 63% of SmartCentres revenue is coming from Ontario. I look forward to their Q2 earnings report in August. We continue building our position. We bought 4.7 shares at a cost of $24.69. That added $8.65 to our forward annual dividend income at a yield of 7.5%. Next, we have our fifth largest holding, TC Energy Corp, at 7.3% of our portfolio. It reported earnings and absolutely tanked, dropping 16% in a few trading days, hitting a low of $43.70, giving it a massive yield of 8.5%. Yeah, you heard that right. So what's my take on the Q2 release? I think it isn't so bad at all. There were two big pieces of news. First, they announced the sale of a 40% equity interest in Columbia Gas and Columbia Gulf to Global Infrastructure Partners for $5.2 billion. The market didn't take this well, as TRP paid $13.4 billion for the asset in 2016. This was done to help shore up the balance sheet. The second major piece of news was TC Energy splitting into two companies by spinning off the liquids business. There will be TC Energy and Liquids Pipelines Company, the latter focusing on oil transportation. I believe TC Energy will be the better of the two companies as it's more diversified. Just 33% of its EBITDA is coming from Canadian natural gas pipelines. I also think TC Energy will be the better of the two because natural gas demand is projected to stay high for as long as I shall live. LNG exports are forecasted to increase 195% out of North America, and power demand is going to increase 41% by 2050. It took me the whole weekend to digest the presentation, so I missed the best buying opportunities of that flash sale. We still added 10.8 shares at an average cost of $49.25 per share. This added $40.23 to our forward annual dividend income at a yield of 7.6%. Our fourth largest holding is First National Financial. It represents 7.8% of our portfolio. It finished the month up 3% and is up nearly 4.3% on the year. I'm still sitting on the sidelines, waiting to increase my position by about 20%. First National will be looking to grow its MUA this quarter. Literally today, they will be releasing their Q2 report. If they tank, I'll be putting my buy order in, as this still has a lot of room to grow in the thrift mortgage space in Canada. Our third largest holding is Capital Power Corp. It represents 8% of our portfolio. This finished the month down 2% and is down 11.4% year to date. There's nothing fancy about this old company. It is just well positioned and managed to grow in the power producer space as it develops, acquires, owns, and operates renewable and thermal power generation facilities. This has a spectacular track record, and I see no concerns moving forward. They're managing their balance sheet well, and this gives me confidence that they'll continue to raise their dividends as forecasted. As I have been saying, we will continue to grow this position as much as we can around $42. So we bought 3 shares at an average price of $41.08. This added $7.38 to our forward yearly dividend income at a yield of 5.7%. Our second largest holding is Bank of Nova Scotia. It represents 8.8% of our portfolio, about 8.8% too much. It finished the month up 1%. Over the past year, it is still the worst performing bank, down 18%, not including its dividends. This is trading 17% above its 5-year average yield, 17% off its 5-year average PE, and 18.2% off its 5-year average price to book value, all indicating this may be undervalued. I need to be clear that I originally built this position when I felt BNS was extremely undervalued compared to the other big 5. I had sold most of my CIBC and TD position in February of 2022, which happened to be good timing. And then I closed out the positions in September. I still believe BNS may be a good value play. TD will eventually overtake BNS and form part of the core of this portfolio again. And lastly, still in top spot, we have RIOCAN Real Estate Investment Trust. It represents 11.3% of our portfolio. It's up 3.5% on the month, and year to date, it is slightly better than SmartCentres, down only 5% on the year. As mentioned throughout this update, real estate continues to feel the heat and has provided attractive valuations in Canada and the US. And with the very healthy FFO payout ratio of 59%, this may give investors more confidence to accumulate shares. I'm looking forward to another solid quarter when the report comes out next month. We're able to drip 3 shares at a price of $19.07 at the beginning of the month. This added $3.24 to our forward annual dividend income at a yield of 5.7%. So there you have it, all 20 holdings we own and which stocks we bought in July. We deployed quite a bit less this month compared to June. $1,793.11, adding $118.21 to our forward annual dividend income at a yield of 6.6%. Check out our July dividend income update to see how much our portfolio made. We still have a lot of work to do with this portfolio, with about $48,000 in Tfsa contribution room to go. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. You guys are awesome. Until next time, I'm Mr. Financial.